Welcome to the Upstream Series episode 19. Today we're taking a look at DNO ASA, a Norwegian E&P producer that has been in business for over 50 years. Most people aren't familiar with this name, but DNO is one of the most exciting turnaround stories in the European upstream sector. Revenue has more than doubled, record production, almost 10% dividend yield, and at the same time, they're operating in the world's most politically sensitive oil region, Kurdistan. DNO ASA was founded in 1971, so they've been in business for 54 years. The executive chairman is Bjørn Mosavang Ramini, an Iranian-American oil veteran who has been running the company since 2011. The business model, exploration, production, in other words, pure upstream. They drill and extract. That's it. No downstream, no refineries, and also no petrochemicals. Historically, DNO was a Kurdistan pure play. They were one of the first international producers in northern Iraq, developed the Tawke field, and have extracted over 500 million barrels from it. 500 million barrels from a single license area. And that is very impressive. But in 2025, the game changer came, the acquisition of Sval Energi. With that, DNO transformed from a Kurdistan specialist into a diversified European E&P player. And today, they operate in 3 regions, the North Sea, Kurdistan, and West Africa. We'll also take another look at my entry point here. Overall, I entered at €1.04. I hold 90 shares, currently up 60%, and I have already received a net dividend of €9.91. When I got in back then, things didn't look quite so rosy, so I wanted to wait and see at first. That has probably developed a bit better now. That's what we're basically looking at today. So it could also be that I simply increase my position here if I see attractive prices again. I work out all my fundamental data with Investing Pro. Use Investing Pro for your fundamental data and get 15% off through my link. You can find the affiliate link below in the video description or in the pinned comment. So let's get started right away. The Sval Energi deal is the most important transaction in DNO's history. Announced in March 2025, completed in June 2025. The numbers: $450 million purchase price with an enterprise value of $1.6 billion. Purchased from High-Tech Vision, a Norwegian private equity firm. Sval had 16 producing fields on the Norwegian continental shelf. And what exactly has changed as a result? North Sea production has quadrupled from around 20,000 to 80,000 barrels per day. The 2P reserves in the North Sea have exploded from under 50 to 189 million barrels, plus an additional 316 million barrels in contingent resources. And most importantly, Norway and the UK now account for almost 60% of global production. DNO is no longer a Kurdistan risk play. They have a stable OECD foothold. $450 million for quadrupling of North Sea production and 189 million barrels of reserves. That's a bargain. High-Tech Vision had to sell. DNO seized the opportunity. This is exactly how you make transformative deals. Full year 2025, 110,700 barrels of oil equivalent per day. A record. That's an increase of 43% compared to the previous year. The highest value in 54 years of company history. The breakdown: the North Sea delivers 54,800 barrels per day. That's the Sval effect. Kurdistan with 52,600 barrels per day and West Africa with 3,300 barrels. In Q4 2025, it got even better. North Sea alone at 88,300 barrels per day, Kurdistan at 58,000. And these are quarterly figures that are well above the annual average. Guidance for 2026, 136,000 to 150,000 barrels per day. And that's another 10% growth on top of the record. North Sea is expected to reach 82,000 and Kurdistan 65,000. And in Kurdistan, a massive drilling program is currently underway. 8 new wells with 3 rigs on the Tawke license. The goal is 100,000 barrels per day from that field alone. Now let's address the elephant in the room. Kurdistan is both the biggest risk factor and the greatest upside for DNO. The Tawke field is DNO's flagship with over 500 million barrels cumulatively produced since 2007. In addition, there's Peshkabir, an adjacent block. The 2P reserves in Kurdistan amount to 224 million barrels. That's still a massive amount of oil in the ground. Now, the story with the pipeline. The Iraq-Turkey pipeline to Ceyhan was closed for 30 months from early 2023 to September 2025. Disputes between Baghdad, the Kurdish regional government, and Turkey. During this time, DNO could only sell its oil locally and at a discount. In September 2025, the pipeline was reopened. DNO is currently supplying around 38,000 barrels per day for export. And in February 2026, DNO announced that they are considering joining the Ceyhan export deal. That would mean higher prices for Kurdish oil. But, and this needs to be said very clearly, there were drone attacks on the infrastructure in July 2025. Equipment was damaged and production was temporarily interrupted. DNO is now rebuilding and has launched an 8-well program with 3 rigs. Kurdistan is a calculated risk. 224 million barrels of reserves, break even below $20, pipeline open again. If the political situation remains stable, this is a cash machine. If not, there could be outages here. DNO is betting that the North Sea will offset the risk. And with 60% OECD production after the Sval deal, that's not nonsense. It's reality. The figures for 2025 are impressive and at the same time a bit tricky. Revenue, 1,474,000. That's more than a doubling compared to 667 million in 2024. The Sval deal is paying off. Operating profit of $513 million compared to $204 million the previous year. Cash from operations, $929 million. Again, more than doubled. And now comes the catch. At the end of the day, there's a net loss of $25 million. How can that happen with almost $1 billion in cash from operations? Taxes. Above all, the Norwegian petroleum tax, which is around 78%, and financing costs for the Sval deal. The dividend. In 2025, DNO distributed a total of $130 million. Currently 0.37 Norwegian kroner per quarter. At the current price, that results in a yield of just under 9.5%. The market capitalization is around 16.5 billion Norwegian kroner. That amounts to approximately 1,057,000 with 975 million shares and a price of just under 17 NOK. Let's get back to the bull versus bear case. The Sval Energi as a transformational deal, quadrupling of North Sea production, 60% OECD exposure, massively reduced political risk. DNO is no longer the Kurdistan gambler it used to be. A 9.5% dividend yield for an oil producer with growing production is extremely attractive, and the dividend is paid out of operating cash flow. Number 3, Kurdistan upside. 224 million barrels of reserves, pipeline open again, 8-well drilling program underway. If Kurdistan delivers, free cash flow will explode here. Valuation at $1,570,000. Market cap and 929 million cash from operations. That's a price to CFO of under 2, and that is just absurdly cheap. Let's move on to the bear case. Kurdistan risk, drone attacks, pipeline interruptions, political instability between Baghdad and Erbil. This can escalate at any time, and you should be aware of that. Number 2, net loss. Despite record revenue, the Norwegian petroleum tax eats up the profits. A 78% tax rate means there's not much left over. Number 3, Sval integration is still fresh. The deal has only been completed since mid-2025. Integration risks have not yet been fully eliminated. Number 4, a small cap with low liquidity, a market cap under $2 billion, and that scares off institutional investors because the spread can be quite wide here. But even here, opportunities could arise, namely to get in before the general public. Where does DNO stand compared to its Norwegian and European peers? Compared to Aker BP, DNO is significantly smaller. Aker produces twice as much and has a clean balance sheet. But Aker only pays a 6% dividend yield, while DNO pays almost 10%. Sval Energi, which we also analyzed in the upstream segment, is a similar Norwegian pure play. Sval also pays high dividends, but has neither Kurdistan upside nor Kurdistan risk. Harbour Energy in the UK is similarly sized, but has just integrated due to the Wintershall deal and is struggling with the British windfall tax. DNO, on the other hand, benefits from the more stable Norwegian tax system. Panoro Energy is the small Africa-focused E&P with higher risk, less production, but also attractively valued. The decisive advantage of DNO, price to CFO, is under 2. None of the peers is valued as cheaply relative to cash flow. The Kurdistan risk is weighing on the valuation. Those who are willing to accept this risk get a discount here. Personally, I wouldn't get in just yet. Here too, I want to see the price or the share come back first. So what do we take away from this? The company DNO has become, following the completion of the Sval deal, an entirely transformed and completely different company, from a Kurdistan pure play to a diversified E&P with 60% OECD production. Revenue doubled, record production, almost 10% dividend yield. But Kurdistan remains a risk factor. Drone attacks, pipeline politics, tax conflict between Baghdad and Erbil. Those who want to avoid this are better off with Aker BP or Sval Energi. My conclusion, DNO is a high yield play with a transformation story. At just under 17 Norwegian krone and a 9.5% dividend, the stock is interesting for investors who are consciously willing to take on the Kurdistan risk. I have it in my portfolio, as you can see, but only as an addition and not as a core asset. Feel free to subscribe and hit the channel's subscribe button if you enjoyed the video and don't want to miss any more upstream episodes. Right now we actually have about 5 more upstream episodes left, and after that the upstream series will be finished. That means you can also just write in the comments what you might want to see next. I might still have rights on offer here, or also healthcare. Rights or healthcare are especially interesting right now because they've really taken a hit recently. Especially rights, some of them are at their 52-week highs and also pay good dividends. If you want, we can also analyze what I have in my portfolio there. Just let me know and then I can simply focus more on that next time. That way you can also help decide what interests you. Otherwise, this video is of course not investment advice, but just my personal strategy. I wish you all successful investing and I'll see you in the next video.